evening, ladies and gentlemen. Welcome to tonight's webinar on how to thrive, not just survive the COVID-19 Australian property market in 2020 and 2021 and beyond. And a lot of things have happened. It's a very interesting period of time that we're experiencing, especially in Melbourne. We're still experiencing the lockdown. Now, I must apologise for my voice before we get started. I do have hay fever. I'll be taking Zyrtec tablets. My garden in the eastern suburbs is pollinating. I've got wattle trees and roses and everything, and I had the gardeners in today all day just to make things even worse. So my voice will sound a little bit weird during this webinar, but I will definitely get through all the information, and the information is very current, and it's very important for a lot of investors to understand exactly what's happening right now in the property market in Melbourne and in Australia and around different segments of the market and different sectors of the market. Before we get started, a bit of a personal disclaimer. My results are untypical. I'm not going to insult your intelligence by promising or implying in any way, shape or form that you'll build a multi-million-dollar property portfolio like I have. But I'll show you exactly what's worked for myself and give you some pointers on how you can implement similar strategies. And in the event that you find them congruent with your risk profile, investment time horizon, then definitely implement them. But this is only general advice. This is not specific advice. If you want specific advice, you have to see a financial expert or advisor, but make sure before you see them, they have the results that you want to achieve. That's the key. Couple of things about myself without boring you guys to death. My name is Conrad Bobilak. I'm a real estate agent. I've got a diploma in financial services in mortgage broking. Years ago, I had a diploma in financial services and financial planning, RG146. And a bunch of other certificates that I won't even mention, and as well as wasting 4 years at Monash University drinking beer at the tavern and shooting pool. But the most important thing is that I'm a real property investor in Melbourne right now. I've got a multi-million-dollar property portfolio. I'm in the market refinancing properties, buying more properties, and I'm speaking all day to developers, investors, and I'm talking about investors that have 20, 30, 40, 50 properties and developers that do 400 builds a year, for example, like Sentinel Group. And I speak personally to the owner of that group, who's a multi-millionaire. And these guys are in the market buying hundreds of pieces of land every year, literally hundreds. So they are negotiating with private vendors, they're negotiating with agents. So all the information that I'll give you today is a combination of fundamental analysis, real stuff, street level, as well as obviously I'm going to back it up with all the usual RP data and all the other RAOV, the real estate .com and all the other sources of information that I usually provide, including government bodies. Also, I want to do a shameless plug of my book, which is Australian Property Finance Made Simple, which you can buy on simply going on bookonfinance.com.au, $30, or any good bookshop like Amazon or Booktopia. And also, my new book is out already in soft copy, which is Real Estate Made Simple, Australian Real Estate Investing Made Simple. And it's got #1 bestseller on Amazon, which is fantastic. Thank you very much for you guys supporting me and writing on those lovely testimonials. So it's gone to #1. You can see that my second book is actually #8 as well. And there's been a couple of times where I had the first 2 positions, #1 and 2, in the real estate sector of Amazon for real estate books, which is very humbling. So really appreciate you guys buying those books. The hard copy of that book, the second book, which is Australian Real Estate Investing Made Simple, is currently the hard copies are sitting in a container on a ship off the coast of Australia trying to dock, and there's slight delays. We were expecting to ship those out to you guys in October, but I think it's going to be either last week of October or first or second week of November. So there's a lot of ships now at the moment being stuck out at sea, and they can't come in for different reasons that are COVID related. As you already know, you watch the news as well as I do. It is what it is. Now we've just had I just had a thing come up that the webinar is full, so it reached 101 attendees, which is cool. So for those of you who have missed out, I'm going to make sure you get a copy of this as well. So no problem at all. Now these are some of the testimonials that I've had, which is great. So it's fantastic feedback. By the way, if you if anyone bought my book on any shop or Amazon or eBay, if you give me a testimonial and just take a screenshot of it and give me a receipt that you've bought the book or evidence of purchase, I'll give you access to my brand new home study recording from 2020 for free. So you can access the latest home study, which you can access at any time. Just because I want to give you a bit of feedback and thank you for writing such really nice comments that you guys are getting value out of the information that I'm providing. Anyway, that's enough for me. Now let's get into the topics. Now these are the things that I'm going to cover in tonight's webinar. Number one, and these are really the fundamental things that everyone's kind of talking about, and I'm not going to go into the obvious things that people are talking about that's on the news because you guys already have that information. I want to really unpack some of these things deeper and give you some real good indicators of what's happening in the market right now, this week, last week, where the market's heading the following week, the following month, where I think the market will be next year, early next year, and mid next year, and so forth. And I want to give you a bit of feedback about what I think the impact of these various things are on the property market. And the first thing I'm going to cover is the current state of the Australian property market state by state. And I'm going to also talk about the performance of the market from January to October 2020 and all the failed predictions of the bloodbath and the 40% market crash. And I'm going to be shaming and naming names as well and shaming academics one more time. Number two, I'm going to talk about the likely impact of the new federal budget, which is huge, and it's the biggest budget we have seen, I think, ever in the history of Australia. I mean, it's $1 trillion effectively that we're getting into debt for at a really low interest rate, which is fantastic. So I'm going to talk about its key influences on specific property market sectors, employment industries, suburbs, who will win, who will lose the most. I'm also going to talk about the huge game changer that is coming into existence on 1st March 2021, which is the scrapping of the restrictive responsible lending guidelines, which were introduced by the Kevin Rudd government in 2009 as a result of the GFC, and there's potential immediate impact on the Australian property market, which is going to be huge. And the funny thing is, guys, I'm telling you now, a lot of experts and commentators that don't have a lending background like I have don't understand the impact of point number 3. They are playing it down. They think it's going to be something very small. This is going to be huge. This is going to be going back to the wild, wild west of pre-GFC. There's going to be thousands of people that are self-employed. They'll be able to basically borrow as much money as they want. It's going to have a massive impact on the property market. So it's interesting now that I'm listening to all these experts. A lot of them I respect, but a lot of them don't have a lending background. They've got a background in economics or not finance or banking, and they don't understand the magnitude of this single change. That's going to be a huge difference in the way that the lending landscape will be operating in Australia. I'm going to unpack this in detail, by the way, and also the people that are going to go into the property market who can't get into the property market right now. Number 4, the impact of the recently introduced first home buyers grants incentives and the likely impact on various suburbs in Melbourne in 2020, 21 and beyond. And we're seeing the impact of this. It's pretty much immediate. I mean, you know, I'll show you all the data and the areas that are booming as a result of this. And also, I'm going to talk about how to strategically position yourself right now in 2020 in order to capitalize on the Melbourne property market rebound that's going to occur in 2021 and beyond. I'm going to show you where I think the bottom of the market will be and where I think the market will pick up and how much time you have to get yourself organized so you can take advantage of the prevailing circumstances. Also, I'm going to share a resource with you, which is how to use my simple 10-point property selection criteria in order to conduct unbiased market due diligence and research in order to correctly identify Melbourne's future hotspots as well as dud areas and suburbs. Areas you need to avoid, like a teen arena concert, and much, much more. So it's going to be a very cool webinar, a lot of information, a lot of stuff you'll be able to walk away and implement pretty much immediately. Now, let's talk about the failed predictions. I love this. I'm thinking of just releasing a book on failed predictions for these so-called academic experts. They just keep getting it wrong all the time. I mean, it's embarrassing now. It used to be funny, you know, like, and I've been, if you've seen my live events, I've been mocking these guys for the last 10 years. But I mean, like, how many times can you get your shit wrong? I mean, there has to be a point somewhere where you just have to pull the pin and retire and just go play golf, you know? just stop writing these articles. But they need some kind of validation, like every other person, you know. And they keep coming back, opening their mouth with no. Because you're an economist doesn't mean anything. You just see one part of the aspect of the property market, 10%, 20% at the most, you know. And this is the thing. This is why they keep failing in their predictions. So let's have a look at what happened of this bloodbath that was supposed to happen, right? This crash that supposedly was coming and it never eventuated. And I keep hearing this, the end is near, you know, this is really it, Conrad, not like the other 29 times that we've failed to predict the market. This time it's really going to happen because of X, Y, Z. And since I was 18, I'm 44 now. Since 18, I've been investing in the property market. And since I was 18, I keep hearing, Conrad, this time it's really going to happen because open brackets, whatever the reason is, closed brackets, is about to happen. And it obviously never happens, and they just keep getting it wrong and wrong and wrong. Now, do you remember this story, Brick and Slaughter, which was on the 16th of September 2018, 2 years ago, by the way? Interestingly enough, they actually they have stopped the comments. They've shut them off on YouTube because they were just getting smashed. Now, their prediction was, this is from 60 Minutes, and my God, have they lost credibility because of this housing crash scaremongering. A television report alleging Australian home prices would crash by as much as 40% in the next year has been slammed by property experts. Titled Bricks and Slaughter, the 60-minute report by journalist Tom Steinford focused on the nightmare scenario outlined in digital finance analytics principal Martin North. It predicted 2/5 of your home's worth will be wiped out in 12 months. Well, wait a second, 12 months for the 16th of September 2019. That's 40% in 1 year. And they said in the story, and I'm not going to spend a lot of time on this story because I've covered this in other YouTube videos and webinars. They said that's just the beginning. It can go as high as 60% and more. Now, the crazy thing is this. I know a lot of people would rejoice if the market crashed, but I'm telling you, it's not going to happen. Even if something were to happen, let's just suspend reality for a second, okay? Because I don't think these people actually play this scenario through to the end. Let's say you're in a $2 million house in Bentley, okay? And you're just a middle class, white collar something. You're working full time. You've got a house for $2 million, right? You got 3 kids, and they're going to local primary school and high school. Your house goes from 2 million to 1.2 million, okay? So it loses $800,000 in value. Would you then, what would you do as a family? Would you run out of that house screaming and go live on the street? No. Would you sell the house? Why would you sell? And if you were to sell, where would you live? You'll need to buy something else. It doesn't make sense, right? Because like, why would they sell? They wouldn't sell at all, because the most important thing that people don't understand, these so-called experts, is that the property market is not an investment market. It's not driven by fear, greed, and speculation like the stock market. It's a necessities market. People live in houses because they need shelter. It's an emotional thing. It's like a car. A car is not an investment, same as houses are not investments. They're not even classified as an investment under the Financial Services Act. They're not recognized an investment vehicle like a bond or an annuity or a stock. So people wouldn't sell, they'll just ride it out because they don't live there to make money. They live there because they like Bentley, and the kids go to McKinnon High School, and they like the beachy kind of nature of the suburb, right? Most people would never sell, even if they had a 50 or 60% drop in prices. I would not. I wouldn't sell my house. I live in the eastern suburbs in a massive block. I'm never selling this property. I would ride it out, right? And that's what everyone has done. So even if the prices somehow, which I don't understand how that could happen, were to drop by 40 or 50%, you would find that most people would stay exactly where they are. They would not sell, because if they were to sell, what could they buy? They probably wouldn't be able to get any money to buy anything else, because valuations would not come in, right? Because it'd be a plummeting, free-falling market. So you couldn't get a loan to buy another house, even if you wanted to, you know, and values would be bouncing back. Valuers would be completely shitting themselves to put anything on the valuation in a free-falling market. So you would never actually get a loan to buy something else. So you have to, even if you wanted to get out of that property, which I don't understand why you would have to stay there, right? You would have no option. So it's like they think the same thing happens in the real estate market as it does in the stock market, where a stock can fall by 40, 50%. I've seen stocks actually delist from the ASX completely, so they go to zero, right? It can't happen with property. It's impossible. And I feel like Bill Murray in Groundhog Day, which is one of my favorite movies, by the way, every time I hear this decline, this doom and gloom, bloodbath on the streets bullshit. And it's funny because everyone's doing it. And the thing is, I've been laughing about it since January. And even the banks do it. CBA came out, this is in May the 13th, 2020, and they said, oh, the COVID's really serious. We should say something to the media. What do we say? We didn't know anything. What do other people say? What's Harry Dent and Stephen Keen saying? Oh, it's going to crash. Okay. We think it's going to go down by 32%. Yeah. If there's a prolonged downturn, that's the worst case scenario, right? And people go, wow, the media just loves it because negative news sells, right? So they had articles printed everywhere, CBA warning, ANZ warning. And then what happened is things didn't go bad at all. By April, they went, you know what? I don't think this market's going to have a correction. Well, we better just come back to the media and say, look, what did we say last time? 32%? I think it was going to be 10% in 6 months, according to CBA. Yeah, 10%. Like that's more realistic. Yeah, so we don't want to panic anyone. It's 10%. And then by September the 9th, CBA came back, you know what? I reckon 6. Okay, how about 6%? Can we do 6? We think maybe 6 is realistic. It falls by 6%. And then eventually, they came back and said, I don't think things are good. I think things are going to go up. I don't think it's going to come down at all. So we went from freaking 32% negative crash, right, to 10% to 6%, and then we went to, I think 0. Yeah, 0, maybe even a little bit of growth. Yeah. I mean, these guys are just, isn't this crazy? Like when you think of how irresponsible is it? And do you remember a lot of people, you guys are educated, you're on this webinar, right? There's a lot of people out there, families that just, they think the banks actually know what they're talking about. I used to work for that, but to tell you, they don't know, it's the blind leading the blind. It's a machine to make money, nothing else. There's no expertise there. But the thing is, a lot of people would act on this and they'll sell the house at the lowest point in the market. This is the worst thing. I mean, investors like myself, I actually want the market to have a correction because I'll just buy more property, because I've got my lines of credit already locked in at the highest possible level. So I want the market to crash and then I can just buy things at a discount. But these families that would sell because of this advice, that's really what concerns me, Jonathan Tepper. Remember, all these people kind of, they appear and they disappear. But I remember, guys, I keep notes. I take very detailed notes of these people and what they say. Where is he now? Is he smiling? He was so smug on the news, wasn't he? Oh, yeah, you're going to drop by 50% next 12 months. This is February 2016, right? And what happened after a year? After a year, people said, what happened to that correction? Oh, yeah, you just wait. And then 2018 came, just wait as well, 2009 or 20. And we're going to go into an upward trend market now. So I don't understand what these guys are talking about. Same with this guy, Lindsay David, 2014, bloodbath. All the baby boomers, apparently in Australia, are going to run out of their houses and sell them. And there's going to be no demand for large 4-bedroom houses on 1,000 square metre blocks in Melbourne and Sydney, located between 5 and 10 k's of the city. I mean, who would want those properties, right? There's going to be an oversaturated market of it's insane, right? When I say I can't even say this with a straight face. There's going to be no demand in Australia for houses 5 to 10 k's from the city, 4 and 5 bedroom houses on 1,000 square metre blocks of land, as hundreds and thousands of baby boomers retire and scale down their dwellings into townhouses and apartments, and there is obviously no demand from anyone else to live on those houses, right? Well, God forbid developers would want them, or I don't know, maybe wealthy people who want a big block with a pool, 5 to 10 k's from the city. Now, this guy's an expert. I mean, he's got his degree in macroeconomics, so he knows what he's talking about. And of course, Harry Dent, my favorite, the ace in the deck. In fact, that's a good idea. I'm gonna have a deck printed off of all the doom and gloomers. Like CIA has those terrorist decks. You got the ace and the joker. Now this guy comes out every time there's a decline in the property market. We're at the bottom, whatever the reason is, it's irrelevant. He'll come out, he'll do a tour of Australia, and he'll say, this is it. Your market's going to crash. Buy gold. Buy my book. And then when the market recovers, it disappears back to wherever we came from. I think it lives in Spain or somewhere. And then if you ring him after after a few years and saying, hey Gutty, hey mate, I've watched your live event. You said the market's going to crash. It hasn't crashed. Yeah, you just wait. You just wait. Wait until it happens. Nothing can stop it apparently now. Australia is on the brink of the Great Depression style economic meltdown that will last 2 years, with house prices falling by 50% and unemployment to skyrocket, experts say. Author Harry Dent predicts massive crash again. So once again, he's back with this massive crash. We'll see what happens in 2 years' time, right? Financial Doomer says Australia property prices will crash by 50% in the coming global crisis. Mr. Dent is currently touring the country to promote his new book, 0 Hour, incorrectly predicted a 50% wipeout on Australia property prices in 2014. So I saw him in 2014 and when he was touring with his book, and I've got 0 Hour, by the way, but he believes this time it's the real thing. Critics of Mr. Dent liken him to a broken clock, which is right twice a day. That's exactly what I say. Even a broken clock gets the time right twice a day. And mind you, if he gets anything right, he'll write it all out. It's like those gamblers, they only remember the wins. They never remember how much money they've lost. While Mr. Dent hits back at mainstream media pundits calling him crazy or an idiot and quack are nothing new. His predictions, the latest in the series of ominous warning going back decades, include stock crashing up to 80% just weeks from now, real estate prices plummeting 30 to 60%, and Bitcoin by 95%. Bitcoin, apparently, according to him, is worthless completely. On the plus side, he sees the coming crash as a buying opportunity, with Australia one of the best positioned countries in the developed world. Your number one country I would invest in, he said. Fantastic. You must have been watching my webinars. So very, very interesting. So these are some of the failed predictions that he made. He made a prediction in 2009 that the market was going to crash in Australia by 55%, wrong. 2011, the market's going to crash by 60%, wrong. 2014, 50%, and we're talking about in a year or two now. He always says, year or two, buy my book, you need it now, right? All wrong. Not only did the prices not fall since 2009, they've risen nationally by 69%. So, wow, maybe we should listen to him and do the opposite of what he's saying. And now he's saying the prices will fall by 50% by 2020. Well, we'll see what happens by the end of the year. He's got no luck picking Dow Jones Index either, by the way, because he's a stock market expert. 40,000 in 2004, 5,600 in 2014, 3,000 in 2018. Dow Jones is currently trading at 25,000. Wow. Some of these people need to go back to the university they got their degree from and say, hi, I'm back. I need my money back. Stephen Keen, another example, 40% within a few years in 2008. Still waiting, 12 years later. Now, the funny thing is they can't, because they've said this and have published these books, they can't just say, you know what, I stuffed up completely. I'm a complete idiot. What was I thinking? I got it wrong. So you know what they're doing these days? They've got this amazing term they've come up with, which is called market disconnect. I love this term, market disconnect. It's saying that the market is disconnected from what's really happening, and that's why it's not correcting. And it's used in the stock market, and it's used in the real estate market. By the way, I'm a big fan of the stock market. You guys probably don't know, but I trade options, I trade derivatives, and I buy and hold blue chip shares. I'm a big fan of the stock market. And in the stock market especially, when things go the opposite way of the supposed experts, they're using this market disconnect term. No, there is no market disconnect. The market is connected 100%. You just got your shit wrong. That's the problem. So the best thing to do is man up and say, I was wrong, and I did say that, and I stuffed up, and then I'm going to keep my mouth shut. That's what I would recommend to these people, because how many times can you get shit wrong until you lose all credibility completely? Like there's got to be some limit there. I mean, go back to the wherever, Monash, Melbourne, wherever you got your certificate from, and just find out. Maybe they'll tell you how many predictions can you fail in until you should be banned from talking to the public. And this is not see, you got to understand, it's not because I find them funny, I find them hilarious. It's like the flat earth people, they'll argue that the earth is flat. God bless them, and it doesn't impact what I do, because I know that they're wrong, and they've been wrong for decades. It's the impact they have on the working class mum and dad families that are completely uninformed, uneducated, and God forbid they'll take that advice and sell the only asset that can give them any security in their lifetime at the wrong possible time. That's what really concerns me. That's why I'm always advocating against listening to these people, because people like myself, we just laugh at them. You know, they're just clowns. They're just broke academics at some campus, you know, talking about things they have no idea because they've never invested. They're not investors. It's like people that do personal training and they can't deadlift 250 kilos. If you're a personal trainer, my message to you is if you can't deadlift 250 kilos, you need to retire and go back to JB Hi-Fi or something, you know? You've got no business calling yourself a personal trainer if you can't lift 250 kilos. It's freaking embarrassing, guys. Seriously. If you can't lift, you know? So if you're only investing, you should have no business giving investment advice to other people. That's the reality. Now, going back to what's happening in the market, every major correction that we've had, and we've had a massive correction, and I'll show you all the data, has been followed by a property boom in Australia. And there's different, every time it's happening though, if you're in the midst of it, it seems more dangerous and more profound, and there's no sight in end. You know, it's just like it's just like you don't know when it's going to end. When the end comes, which we know that the end's coming now, and I'll talk about those factors, then it's like, oh well, that's fine though. It's coming to an end. Let's do something good. And you can see there, you know, we had the 90s recession, and you can see there how far the market dropped. Between 1995, we had massive interest rates. We had rising unemployment, 11.7%. We had a very slow economy. We had a property market that wasn't growing. We had the introduction of capital gain tax on property. There's a lot of stuff that was introduced that was really working against real estate investing. Then we had the Asian currency crisis, 2000. We had the dot-com bubble bursting in 2005. The GFC. Do you remember the GFC? How the sky's falling, everything was going to. I mean, properties have tripled since the GFC in some suburbs in Melbourne and doubled in most areas. That was 2010, guys. It was 10 years ago. 2008, 2009. You know, there's a lot of properties that have doubled since that period of time. I bought a property in Vermont in 2008 for $650,000. It's worth now 1.8 million. I made 1.2 million just sitting on the property doing, you know, it's basically just appreciation. There's a lot of people that made a killing after the GFC. 2015, we had the China steel glut, which affected all the mining towns around Australia. And then we've got the COVID-19. It's just another reason, another dynamic in the economy that has affected things, except this time, it wasn't that the economy broke, we shut it down on purpose. And that's why the recovery is going to be much faster than the other times, because the other times, things actually broke down. So if I can use the analogy of a car, we had car problems with the engine stopped working. This time we turned the car off and just pulled to the side of the road. So the recovery this time, I believe, is going to be much faster than anyone anticipates, because things will go back online very quickly. Yes, some businesses won't recover, and the way we work will change forever, because people have worked out that they're more efficient working from home than they are in the office. So there's going to be a massive impact on commercial property, the way we communicate through Zoom, through Google Meetups, etc., etc. But fundamentally, nothing's going to change with properties. In fact, properties will just go up even more so in the right area. Will people lose money on real estate? Guaranteed. People are going to lose money on everything they do for the rest of to the end of time, because it's the person. The risk is always with the person, not with the market. One thing that I believe now is I don't believe there's any market risk at all. The risk is with the individual 100%, you know, because during the market downturn, people like myself, we buy property at discounts. And I had, you know, back in March, April, May, which was the bottom of the market in Melbourne, I had the opportunity to offer some of my clients discounted properties in St Kilda, townhouses that originally sold for $895,000 for $740,000, $750,000. They were 140 grand below what the original ones settled for. So they made 140 grand or discounts immediately because someone else fell over on that property and the developer kept the deposit. Not my clients, other clients from other agencies. So I had 6 properties that were distressed during this COVID-19, and they were discounted by over $100,000. So those people just killed it. They made 100 grand on the way in. I was really disappointed, by the way, that I didn't have more distressed stock, because I thought there'll be, I was hoping for 20 or 30 pieces of distressed stock. It didn't eventuate at all. People just pulled everything off the market. The market shut down. Agents got shut down, as you know. We couldn't do open for inspections or anything. And so there was nothing happening, and people just didn't sell anything. So there was no distressed stock at all, which is crazy. If you look at what's happening in Melbourne in the last 12 months, this is from October. Melbourne last week lost 0.2%, for the month 0.6%, for the year negative 3.1%. but we're still 1.5% positive for the last 12 months. And we're about to go into a recovery phase, which I'll talk about in a second. And Sydney's already gone into recovery. Weekly change 0, monthly 0.2, for year 1.4%, and for 6.6 for the last 12 months. And Brisbane 3.7%. So it's very interesting in terms of market recovery. And Adelaide now 4.3. So in terms of monthly changes in the index and dwellings, you can see there, this is the monthly change in home values, 5 major capital cities combined together. So we have the monthly change in the index and the dwelling index. You can see there, we've already passed the bottom. The bottom was, probably about 2 months ago, and we've gotten up already. And look, now that real estate agencies have opened up since last Monday, we can do open for inspections one-on-one. That's going to fuel the market, and it's already had a massive impact on auction clearance rates in Melbourne and the amount of properties that are getting listed. Because what happened was when real estate agencies shut down, people stopped listing properties because no one could sell those properties for them. Remember, this is usually real estate is the biggest asset you own in your whole lifetime, so you're not going to jeopardize selling something cheap, right? If you've worked really hard for it all your life. People are not stupid. If they're sitting on $1 million worth of property or 2 million, they're not going to dump it for nothing, right? So agents also work on commissions, and they tell them, listen, the whole market shut down. There's no point you doing anything at the moment. Just let's ride this out. And when COVID-19, where we go into some kind of version of normality, let's then sell your property in the spring auctions, or we'll sell it in 2021. So the volume of properties on this Melbourne property market shrank completely. It went to virtually, some suburbs have lost 80% of the listings. So instead of, let's say, 80 houses, it went down to 20 or 10. So people just took everything off the market. The only properties that were being advertised were deceased estates, divorce, or dumb, which is the 3 Ds. Or people that had to sell because they're moving to Queensland or they've committed to another property somewhere else. But really, just a normal transaction where someone's upgrading a house, they were taken off the market completely. So this thing about when people in January were telling me, oh, it's going to, in March when COVID-19 lockdown started, and then by April, May, people saying, oh, this is going to be, bargain central. I was very skeptical because I could see the numbers already on RP data where people were taking properties off the market. And that's what happened. So even when you have a correction in the economy, guys, no one sells anything. So there is no correction. And this is why we can't get this 40% drop. Because people are not desperate to sell. People have buffers in place. And this is why these doom gloomers always get it wrong. And this is why we can see their combined, Melbourne pretty much follows the combined capitals very closely, but it's obviously overshoots them because it's one of the most important markets in Australia, but Sydney is the most important market in Australia. So the end is not near, guys. The end was not near. Nothing happened. To put it into perspective, 1.5% growth for the last 12 months. Okay, that's October to October, 2019, 2020. So where's this 40% crash? Never eventuated. COVID-19 federal budget, very important. Let's unpack it in detail, and the likely impact of the new federal budget. Its key influences on specific property market sectors, employment industries, and the suburbs. Who will win and who will lose the most? Now, 3 major housing-related measures were highlighted in Treasurer Frydenberg's budget address on the 6th of October. I was watching these very attentively, and I don't hardly ever watch TV. I just don't have any interest in TV, but I've watched more TV now because of these budget announcements and financial programs analyzing different aspects of COVID-19 than I have in the last 20 years. I mean, I've made a decision 20 years ago to stop watching TV. But I've been reading and watching a lot of TV lately, but only specifically on these topics because they are relevant to my property portfolio. So I just want to give you some of the highlights of these information and how it impacts different aspects of property investing. An extension of the first home buyers loan deposit scheme, which is very important. Additionally, low cost financing for affordable housing through NHFIC, and additional funding for Indigenous home ownership program. Other measures detailed in the budget paper included the proposal of capital gain tax exemption for granny flats, which is really cool because you can put a granny flat at the back of your property, turn it into a cash flow positive property. Very popular in New South Wales. You don't need permits as long as it falls within a specific square meterage. And in Melbourne, a little bit harder to do, but also a very good strategy if you want to buy established property. Chuck a granny flat at the back. And look, there's so many companies building them now, and they're doing them amazing jobs. I mean, these are really cool next level granny flats, not the ones that were around 10 years ago. You can turn in the cash flow negative property into cash flow positive from day one. And continuation of funding for state social housing services. The paper also noted that the expansion of the first home loan deposit scheme will be complemented by announced changes to ease credit regulations, which is huge, and I'll unpack that as a separate topic, which would boost credit availability. First home owners have previously been target of demand-side housing stimulus during economic downturns, and rightly so, because new houses there's a flow-on effect on the whole economy. Not only the people that are involved in building the house, the tradies and the company that makes all the money, but it's real estate agents, mortgage brokers make money. Then you got the builders buying materials from Australia, buying imports. You've got admin people associated with the house. And then you've got the tradies building the house. Then you've got people moving into the house. When they move in, what do? They buy furniture, white goods. They buy plasma screens. They buy brand new cars. It has a massive flow-on effect in the economy. So one of the best ways to stimulate the economy is to make it really attractive for first-home buyers to buy a house. It really has a huge stimulus. And the government knows this. This is one of the aces in the deck that they can always play during a downturn. Currently, Australia may be in a demographic sweet spot for first-home buyers' demand. The relatively large millennial generation now estimated to be around 26 to 37 years old, which means most of them have saved a deposit, at least to buy the first home or rent and invest, renting in an area they want to live in and investing as well. According to ABS data, this put millennials into the most common first home buyer age groups. Alongside the typical barriers to entry for hopeful first home buyers, this may be one of the reasons the first home loan deposit scheme has been so well subscribed since its introduction in January this year. The extension of this home loan scheme will see an additional 10,000 places made available between the 6th of October and the 30th of June 2021, adding 20,000 places made available since the scheme started in January 2020. However, these additional places are for construction or purchase of newly built homes, which is the best thing they could have done. The price threshold have also been increased for newly built homes, which would potentially further incentivize a pivot away from the established housing market. The change in purchasing thresholds by region is summarized below. So what they've done is really cool. They've increased the actual price of new homes, because like if you look at Melbourne, in Victoria now it's $850,000 is the purchasing threshold, the maximum. New South Wales is $950. I mean, they used to have like $750. You can't get much from Melbourne for $750. You'd be missing out a lot of good estates. Queensland $650. So it's a really good threshold. That's for the city centres. And then if you go regional in Victoria, it's 600,000 and 550 for the rest of the state. So previously, I mean, it was just uncomparable, So 850, and previously it was 600 for Victoria, and then for the rest of the state, so regional 550, and before that it was 375. So that's a very good increase in the thresholds, which means you're attracting people into areas that are closer to the city, much more well equipped. In terms of amenities, transport, everything else. So this will definitely stimulate the economy and have an immediate impact. And I'll show you what the outcome of that was. It'll be interesting to see if these conditions create a rapid uptake for places in established housing. It has minimum impact on established housing because you can't get anything for that price in good suburbs at all. The two-bedroom townhouse now in a good suburb in Melbourne is $850 to $950, and the three-bedroom townhouse is 1.1 to 1.7. So if you're a family, you can't live in a two-bedroom townhouse. You're going to buy a four-bedroom house with double garage. So you're pretty much priced out of the top 100 suburbs in Melbourne. The temporary boost to the first home buyers grant provided added incentives for new builds, yet 85% of its uptake was direct at established housing. However, incentives limited to new home builds could still help soften the blow of dwelling construction through COVID-19. I remember Melbourne has that 85% is throughout the whole region of Australia. There's different prices and different dynamics in different major capital cities of what you can get and what you can't get. However, incentives limited to new home builds could still help soften the blow to dwelling construction through COVID-19. Since the introduction of Home Builder Scheme, new home sales have boosted across Western Australia, South Australia, Queensland. And that's why they've taken off a lot compared to Melbourne, which is pretty much closed down, but we're still doing really well with new home sales. CoreLogic data shows valuations ordered for the purpose of construction loans have seen a boost above pre-COVID levels since the introduction of the Home Builder Scheme. In terms of the impact of these schemes would have on the established market, the increased incentive for new home builds could reduce established home price if demand is diverted from this sector. However, the price of newly built homes may rise up to the threshold cutoff, which it will. Developers will increase prices as well. They're not stupid. It's worth noting, despite the rhetoric employed around the extension of the scheme supporting the construction sector, the budget papers highlight this will not be enough to offset a decline in new dwellings investment. And the reason for that is because lending restrictions are still making it impossible for new home buyers to get into the market. That's why they can't save the deposit. That's the problem. It's not all these incentives. The 10% deposit, guys, is a lot of money to save, and even with everything else, reducing that deposit to 5%, they've still got to save money, and living expenses are very high in Melbourne and Sydney, and this is what young people struggle with. At August, dwelling approvals for units have fallen 18.4% year on year. The budget papers forecast 11% decline in dwelling investments for 2021 before rising 7% in 21-22. I completely agree with that. So you can see there, this is valuations ordered for the purpose of construction loans, 7-day rolling average. And you can see there in June, that was when the announcement of the Home Builder Scheme was introduced. And look what happened to the property market. It just went up. See how it's so reactive completely, you know, and then so you can see the volume of valuations that went up, which is a good measure of construction loan applications. And if you look at the budget, the crazy thing is, you know, people talk about how we're going into $1 trillion worth of debt. Is that healthy? It's a scary number. You know, so you look at the third line, gross debt, you're looking at, you know, 684.3 billion 2019-20, and then 872, and then in 21-22, $1 trillion. I mean, that has never happened in our lifetime. And, you know, they say it will take about 15 to 20 years to pay off. Who knows? It's still a very healthy percentage of GDP. You know, we're talking about 50% of our GDP. So if you look at other countries, which I'll show you in a second, the percentage of GDP is much lower in Australia compared to other countries around the world. I mean, there's countries that have 100% GDP to debt ratio. So there's you know, we're in a very healthy state. In terms of the impact of these schemes we have on the established market, so we covered that. So a couple of things. These are the three main things that will impact the market. So, and this is with much of this year's budget focused on labour markets, infrastructure, construction, and tax cuts, which is good. One could be forgiven for thinking that housing reform and stimulus took a back seat in this year's budget, which is true in terms of how much money they were spending on different aspects. The Job Maker Hiring Credit and Job Trainer Fund is very important. These incentives may help reabsorb of young people into the labour force following the initial pandemic-induced shock. This reflects the disproportionate job loss of young people through COVID-19. Around 40% of job losses between March and August were among those aged 24 and under. So the thing that no one's talking about is the people that are unemployed, and we have a very high unemployment number now, and forget about the 7, 8, 9%. I reckon it's 12, 15%, because people that are not actively seeking work are not counted. But the thing is, they're not important in the property market because these people don't own any property. They're too young to own property. So even though the numbers are shocking, what we're finding is it's a very targeted sector of the economy that has lost jobs and it's not able to get jobs. Mainly people are aged 24 and under. Job losses among younger Australians may present less direct risks to the housing market due to the lower likelihood of holding mortgage debt. However, support for youth employment may create more buoyancy in the rental market. In the city markets in particular have seen rental incomes decline since the onset of COVID-19. Inner city markets have declined because students from Asia never arrived to do their courses in Australia. So Melbourne, Monash University, you know, all the TAFEs, they never received those migrants coming in to do their university degrees. And I keep telling people, never buy properties in the city. Forget about apartments in Melbourne altogether, guys. Nothing's going to happen in apartments in the next 5 years. And Dockland South Bank or any kind of purpose-built accommodation around Monash University or Melbourne is zero growth. In fact, it's negative growth. So never buy any purpose-built accommodation targeting students. Students are your worst tenant, guys. Remember, these kids are broke and they damage your property. Your number one tenant is a doctor, full-time, responsible, high-income earner that's never home. Okay, so people keep talking about university campuses. That's a negative aspect of your property. Forget about university campuses. I keep telling people for the last 10 years, do not worry about university campuses and never allow your property manager to put a student in your property. I just tell them don't to do it. You know, you need someone that's employed full-time. A boost to infrastructure spending, depending on the nature of infrastructure projects surrounding housing markets, could see a rise and fall in demand. Much of these infrastructure allocation is on roadworks, which can have positive impacts on nearby housing by increasing accessibility to the area, but they evaluate properties with exposure to high traffic intensity, construction, noise pollution. This is going to have zero impact on the property market. Infrastructure spending is bullshit. We need it, obviously. It has no direct impact on the property market. Remember the top 100 suburbs in Melbourne, the top 100 suburbs have no infrastructure spending at all. All the schools and infrastructure was built up 100 years ago or 50 years ago. So if any of these stories people tell you, oh, they're spending $1 billion here or half, it's all baloney. It doesn't affect anything at all, zero. So there's going to be no impact on the infrastructure spending. It has no impact on the property market related. And I've done videos on this topic. There's no link and no correlation. Support for regional Australia. The budget outlines $350 million in support for regional tourism to attract domestic markets and seek strengthening regional industry through concessional loans to farmers, etc. So yeah, I mean, look, Bendigo Ballarat's going to benefit. And there's a funny thing that's happening now is people are having tree change where they're moving away from city centres and retaining their jobs and moving into regional areas. It's happening in New South Wales as well, and to some smaller extent in Brisbane. But Melbourne especially, I know a lot of companies that have moved to Bendigo. They've relocated everything, the whole staff, everything. They've lost a lot of staff, but a lot of staff followed them. And the owners literally just bought a house in Bendigo, bought a big mansion, and they live there and they work there. And they're happy as can be, because they don't need to be in Melbourne. They don't need to pay those exorbitant prices for commercial office space in Collins Street. They can pay a fifth of the rental in Bendigo and have the same internet connection speed. There is no advantage anymore in location. This old notion of being on Paris and Collins Street. Let me tell you, my lawyer, I'm with a legal firm called Bazzani Scully Priddle Lawyers. They're at Collins, the law precinct. It's a nightmare. I can't even park my car around there. Why would I ever go there? It's worth nothing, Paris end of Collins Street. It's a freaking nightmare. You can't park. And if you do park, and I've got a long Mercedes-Benz S-Class, I can't even get through those bloody car parks because they're too small. Someone will scratch my car. So I don't even go there. If I have to go there, I literally Uber it from St Kilda Road or St Kilda office to the city, because you can't park anywhere. So this thing about this prestige location, Paris End, Collins Street, it's all bullshit in Melbourne. People hate the city always. I would never even apply for a job that had an office in the city, because I don't want to be stuck in peak hour traffic. So believe it or not, in the last 20 years, the biggest choice for my employment, when I had to find employment, was location of the office. And it was always Albert Park or somewhere, St Kilda. I would never work in the city. It's a nightmare. And same in Sydney. I knew people were insane, stuck in traffic for an hour and a half every day. So, and now that whole thing is out the window. A lot of these corporate, giants like PricewaterhouseCoopers, like IBM, like you name it, consulting groups, to technology companies, to biotech firms, are questioning the notion of, do we need all this office space in the city? Is it worthwhile? Because we can have our employees working from home just efficiently, if not more efficiently, as they are in the office. Because you waste a lot of time in the office talking to people, doing stuff that's not related to your job. I mean, I'm guilty of it, absolutely. So have a look what happened in June when all this stuff was introduced. You can see there we had basically in June 2020 we had that kind of shifting phase of when things changed and shifted. and unemployment obviously went up because it was forced unemployment, and we can see their real GDP went down, and now it's slowly recovering, and this is the forecasting from the government of where it's heading. Is the unemployment rate, which will peak at 12, 13, 14%, before economic support, and this is after economic support, even if it were, let's say there was no economic support and it did peak at 12%, 13%, when now it's going to peak at 8%. And I don't believe these numbers, by the way. I know that it's higher than that. It's about 12, 13, 15%. But is it important unemployment? No, it's not. See, majority of people that own houses in the best suburbs in Melbourne are baby boomers or white collar professionals in the medical or banking profession, and they've retained their jobs. They're working from home, but they're still paying their mortgages and they're saving more money than ever. And in fact, this year, none of them have been on holidays. I mean, I had one holiday this year in Hamilton Island in January for 10 nights. And thank God we had the holiday, because this is the only holiday I had in Melbourne because everything shut down. It's one of the very few years I haven't been skiing. It's crazy. But a lot of these baby boomers, not only have they kept their job, they've saved a record amount of money this year. So they've got massive buffers in place. So even if unemployment were to go to 12, 13%, majority of that would be made up of young people under the age of 26, or people that work in hospitality, tourism, or the airport. And these people don't own a lot of property. So what I'm telling you is that this time around with COVID-19, the bizarre thing of this economic downturn is that it was a very targeted economic downturn, severely affecting some sectors, and virtually have no effect on other sectors at all. There was no flow-on effect. I've got a lot of clients that are in the medical field, for example, because I used to work for Medfin in a previous life. So I've got a lot of nurses, doctors, GP specialists, anaesthetists, surgeons, and I can tell you now, they're all buying lots of property. They've made record amounts of money this year. They're virtually, a lot of them, especially the nurses, have been working around the clock, not because of money, because of the, they just feel they have to, because a lot of nurses are getting, sick, or they're in lockdown, in hospitals, so they're just covering their shifts, and they're working 7 days a week, and they're going into penalty mode, and they're making more money than ever. So what's happened is ironically, even the numbers look really bad. If you dig into the numbers and look at who's representing these numbers, it actually hasn't been that bad at all. And that's the interesting thing about this particular COVID-19 virus and the budget. This is a breakdown of the revenue and the budget, where it's all going. Individual tax, income tax, and these are expenses. So it's very interesting in terms of the breakdown of where we're getting money from, where the revenue comes from in 20 to 21, and also where it's going. We can see the individual tax returns, so $222.2 billion, that is the biggest one. And then we're spending virtually all our money on security and social welfare. So we're spending virtually everything we get from our taxes is going back into our society, which is good. It's a good measure of how advanced we are. You can always tell how advanced a country is by the way they treat the most vulnerable in society and animals. And that's the measure of how advanced a society is. So you look at some countries, I'm not going to name names, but you can see how inhumanely they treat their animals and how poorly they treat their homeless people. That tells you a lot about how advanced they are as a nation. And in Australia, we're one of the most, probably top 10 in the world in terms of how we treat, animals, and how we treat people that are on social benefits. Can we do more? Yes, we can, always. We can always do more. And we should. We should always do more. We should always tax the rich, as much as we can, in order to support the most vulnerable in our communities. Absolutely. In terms of the mortgages, so what's happening in 2020, you can see that we had a massive decline in mortgages, and now we had a spike. Since around September, October, we had new mortgage spikes and refinancing. And I'll talk about this a little bit more. So we can see there's a clear recovery, and it's a clear link between investors are back in the market as well. So we had a bottom out of the market, and owner occupiers are driving the whole market. And owner occupiers predominantly made up of people that are upgrading their houses and people that are buying, and first home buyers into the market. First home buyers are definitely going in hard, and you can see there the increase in first home buyer mortgages is record high. So the incentives that the government has introduced and has been introducing have definitely worked, and they're the ones that are going to restore that bottom part of the economy and the employment sector. So it's a really good outcome for them. Also, the consumer sentiment has come back as well, which is very important. So you can see there, you got consumer sentiment and the capital dwellings across 8 major capital cities in terms of what they're doing. So consumer sentiment has recovered as well, and which is important because when consumer sentiment is record low, which was kind of during the COVID-19, people are very negative. They can't see the end. They can't see the light for the end of the tunnel, and they stop spending. They start saving. They get depressed. It impacts their productivity. Now consumers are back in terms of their sentiment. And remember, perception creates reality. People's perception of where we are creates reality. It's a self-fulfilling prophecy. Most investors know that the worst is behind us, and properties are just going to get more expensive from now on. And that's what they're doing. They're going in now and buying up hard. This is prices through the pandemic. You can see that Melbourne, all the major capital cities have recovered. Adelaide, Brisbane, Sydney, Perth. You can see those lines have recovered well and truly. And remember, the first grey line on that graph is when we had the border closures in 9 p.m. 20th of March lockdown. And for Melbourne, it was from 12 on the 8th of July, and then we had Victorian stage 4 from 4 to 6. So you can see there all the various lockdowns that we've had, and you can see that the Melbourne property market, the blue line, is still down where the others have recovered because we were kept in lockdown the longest. The moment we open up and businesses go back to normality, things will open up again and things will recover very quickly. One of the biggest things that we keep hearing is there was going to be this supposed cliff in end of September, right? Because there was going to be these 1.5 million home loans that are in mortgage stress that the banks wouldn't extend and wouldn't allow them to defer interest repayments, and these people have lost their jobs. Now, anyone that's, guys, you got to understand one thing, okay? It's in no one's interest to have 1.5 million people or 700,000 families on the street losing their house. And I'll tell you the different reasons. Number one, no one wins out of it. Number two, you got to think about the banks. The banks, and if you follow the banking inquiry, let me tell you, the banks are complete parasites, right? We have to agree with that. I mean, charging deceased estates, all that stuff. I'm not going to go into it. I've done YouTube videos on how much I hate the banks, and having worked for one, it's a pure psychopathic institution that is made to extract as much money from the public as possible. However, when you have hundreds and hundreds of thousands of properties that need to be repossessed, the banks are not going to repossess them, because if they do, they have to write them down as bad debts. If they write them down as bad debts, then it affects the profit margin. It affects the profit margin, it affects dividends to shareholders, number one, but also the stock price. And remember, the banks are run by people, psychopaths, that only want checks for themselves. They want bonus checks. So you have these middle managers, they're on $300,000 to $1 million per year. They get paid based on the performance of the bank. So what they'll say is, guys, come on, we're on this together. The banks, we love you. We're all Australians. You know, these are families. No one wants to see, you know, families in Pakenham losing their house and being on the street, mum and dad with 4 kids. You know, we're going to look after them. We're going to defer their mortgages until they're back on their feet. You know, so we're just going to keep extending, and they can just capitalize the interest and defer interest payments until Bob gets his job back and Kathy goes back to the bakery. You know, the reality is the banks don't give a fuck about those families, okay? The banks just don't want to write down these debts as bad debts because it will affect their bonus checks, it will affect their stock market price. Their share price will drop by 30, 40% immediately. So it's not about being a good person or a good Samaritan of helping the public or in this together. We're never in this together. It's always the banks versus everyone else. But what they can't tell you that. So they're going to sell it to you as a big PR exercise. They're going to say, come on, no one's going to win out of it. And the reality is true. Number one is they don't want to write these home loans as bad debts, so they'll allow them to ride. Number two, Imagine they had to repossess 300,000 homes. Do you understand the logistics behind that? I mean, in America, they couldn't handle it. If you learn from easily from the GFC, you don't do that because there isn't enough administration officers and legal staff to even have that processed. So in America, they ended up with zombie mortgages. So properties that were in the system, they were technically not repossessed, but they weren't walked away from the property and sent the keys back to the bank. And in America, they've got no recourse lending, which we don't have in Australia. In Australia, we have full recourse lending, so different rules. But the banks will never allow such a problem to appear on the balance sheet because they've got too many millions of dollars to lose. So the government doesn't want it to happen because they'll have to put these people up in shelters and you'll put a strain on the economy, right? The banks don't want it to happen because they'll lose millions of dollars. And not only the banks, it's the individuals inside the bank, those people, those parasites that will lose their bonus checks. And if they lose their job over it, they'll never get another job like that again. So to lose, no one wants to do this. And the families, they don't want to lose their house either, right? They're in Pakenham in a 4-bedroom house. They've worked hard for. They've been forced to stay home with their kids, not their fault. Why should they be kicked out of their house? They want to go to work. It's the government telling them they can't work, right? So you've got these. So every party, it's in every party's interest to make sure that these stressed properties that are currently out there, and I'll show you the numbers for these properties, they will never get repossessed, guys. It's impossible. The system isn't designed to cater for that, you know, and they'll never get sold anyway. There's not enough demand for those properties either because no one wants a 3-year-old Mexican home, you know, in Point Cook. You just get a new one. Why would you buy a 3-year-old one? You know, so these stress suburbs are concentrated in the fringe suburbs of Melbourne. So the way the banks will sell this to the public is in March when the whole thing comes, they'll just extend it further. ASIC already said in APRA, you have to allow these people to extend it. The government doesn't want to deal with them because it's a headache, and the banks don't want to deal with it because they'd rather just keep them in their house, and when they come back, they can repay their loans. So they just defer repayments, capitalize the interest. I mean, this is a no-brainer, guys. If anyone thinks that we're going to allow 300,000 homes or 500,000 homes in Melbourne to go insolvent and then sold at auction, you believe in fairy tales. It's never going to happen. It can't happen. There's no infrastructure to support that kind of liquidation. You know, it's just so these people that sit there go, oh, there's 1.5 million Australian homes that are mortgage stressed. Well, that's going to create X, Y, Z. No, it's not. Nothing's going to happen. They just keep extending it until it works out. Everything will be extended, guys. Okay, there's a conspiracy, a good one, between the banks, the government, valuers, financiers. No one wants these families to lose their homes. Okay, and that's what's going to happen. None of them are going to lose their homes. Even if they can't pay their mortgages, they will let them ride it out until they get jobs again. That's what's going to happen. And mark my word, just look at the YouTube video, look at this webinar, come back 2 years from now and tell me how many have defaulted, you know. And it's just crazy when people think this is going to happen. There's some idiots on YouTube's going, yeah, when all these homes are going to get refinanced. I'm thinking, use your brain for God's sakes. We can't allow it to happen. It's never going to happen. So I'm passionate about this topic. I mean, you know, people talk about this stuff all the time. They think it's really going to happen. Almost 1.5 million Australian households are currently experiencing mortgage stress. Now, mortgage stress by definition is when you're 3 months or more behind your mortgage repayment, which means according to your contract of sale or your mortgage binding agreement, you can lose the house. They can repossess the property and sell it, and then sue you for anything that they've lost. If there's a buffer, if there's money left over, they'll give you the money, obviously, but they have to charge you repossession fees, agents fees, etc., etc. The federal government support programs to help ease the financial burden of COVID-19. New data from Digital Finance Analytics shows that in 2020, approximately 37.5% or 1.4 million households were technically defined as being in mortgage stress. Now, part of that is they deferred the Now, remember, not everyone that deferred was in mortgage stress, but they had to say they were mortgage stress to get the deferred payments. Before the corona pandemic began, the number was 32.9%. So it's already high. So 3 out of 10 houses, but they don't tell you that these houses are in the same suburbs. They're not evenly spread throughout suburbs in Australia and in Melbourne. According to DFA, mortgage stress is defined as household being forced to pay out each a month, including mortgage repayments, then income being received. So obviously, if you're at home not working, how can you have income? You know, if you're told to stay home and don't leave, well, there's no income. Analysts also believe this number is a high watermark that is distinguished a harder drop to come in September, described as September cliff. Well, the September cliff came and went, nothing happened, right? It's another cliff, and now it's the March cliff. It's always going to be something in the future, right? It's always going to be, and then it's going to be the June cliff, and then December cliff 2021, and then it's going to be 23 and 25. When government support areas are removed, then they're going to be removed, they're going to be extended. The DFA projects the number of distressed mortgage payments could rise to 40.3%. DFA principal Martin North said the data revealed Tasmania as a hotspot for households struggling to meet the repayments. Across the states, Tasmania has the highest portion of households in stress, a function of lower incomes, recently rising home prices and mortgages that stalled tourist sector in the states. Well, there's no tourism, people are sitting at home not working, and prices went up because they had a mini boom in Tassie. So of course it's going to be like that. Let's look at some real indicators of what actually has transpired with these areas. So if you look at Melbourne, let's go back to the basics. Auction clearance rates in Melbourne, now the market's opened, we had some good runs. We had 65%, last year, same time, 73%. So 6.5 out of 10 houses sold. But the number of auctions, 188, is nothing. Look at Sydney, 707. Normally in a week in Melbourne, we have 750 to 1,000 auctions per week, okay? So we're selling virtually nothing. That's why these people that keep analyzing this data are not putting the data into the context of what's happening with COVID-19. The market is virtually non-existent in Melbourne. So you can't read this data and have any kind of correlation to a normal market because the market, it's shut down. It's like saying you've got a bakery, you're making bread, and then suddenly you shut down your bakery, and people go, well, how's your revenue going? What revenue? The bakery's not working. Well, how many bread loaves have you sold? Well, we haven't sold anything. Well, that's bad. So you're down 100% from last year. No, we're shut down. There is no market, you know. So all these numbers that we're reading into Melbourne, any good agent would tell you, don't sell your house now. Wait till things open up and we go back to normality. So, you know, we can't look at this data in a normal way. Weekly auction clearance rates, if you combine the major capital cities into one, you can see that clearly there was a recovery. There was a low point going back up to normality. Melbourne dragged down that low point a lot because we have a huge amount of auctions happening in Melbourne. For example, Brisbane 74, Adelaide 78, Perth 26, Tassie 2 in one street, Canberra 59, and then you got 770, probably 750 in Melbourne in the normal market. So obviously when Melbourne got shut down, that dragged that data back, and now that is back to normality. So all those people that are listening to this webinar who wanted to pick the bottom of the market, the bottom was 3 months ago, guys. Okay, the bottom was all the engineering people with Excel spreadsheets. We missed the bottom again, and there was no stock to buy. That's the sad part. It's now going up again. Okay, so the bottom, and this is the problem with data. Like I keep telling people, we're always looking back at data because the data has to be analyzed and has to be captured. So we never know where we are today. I've got a gut feeling where we are, but I'll know 2 months from now and 3 months where we were today in terms of the market. But I can tell you the bottom is past already. And so all these people that they think they bought 3 months ago, if you haven't, prices are going up slowly now. Land's going up already. So, and I was there at the bottom. Well, there's no good properties to buy. That was the irony of the situation in the open market. Most of the mansions were taken off. Most of the waterfront properties were taken off. Good townhouses were taken off. Developers stopped sourcing stock. Developers shelved projects. They don't need to sell at the bottom of the market. No one needs to sell. If you're a cashed up developer, why should you sell at the bottom? You can hold out. You know, take a holiday, come back next year. So this theory of picking the bottom of the market is just baloney. And if you can pick it, guys, you should just play Powerball, because my God, you must be a genius, because we can't. No one else can pick it. So if you can pick the bottom, and if you bought property, you know, in June, July, which was the bottom of the market, God bless you. That's phenomenal. You know, I could. It's phenomenal if you did that. Also in Melbourne, as we know, we have very distinctive markets. We have, this is October auction clearance results in the city, 68.4%. Melbourne East, 57%. In the South, 70%, 7 out of 10 properties sold. North East, 55, so 5 5.5 out of 10 sold. Northwest, 66%, outer east, 60%, southeast, 53%, west, 76%, and then Mornington Peninsula, no sales. They've taken them off the market. Other indicators. So Australia, you can see there, we have the bottom of the market was the first or the fourth, but I mean, you're combining all the major capital cities, right? So where was the bottom of the market? Let's talk about it. COVID-19, national restrictions easing. Across Australia, across houses and units, which is apartments, we had the bottom, the first or the fourth, and then we went up and then sideways, right? And this is long-term average. This is the buyer's index. If you look at Victoria, same thing. So March, April, and then really May, June, July was the bottom, you know, and then because the volume was low, but buyers went in, and if you could spot a bargain, you bought it, but there was virtually no bargains available because the best properties were taken off the market. And then we had another one in Victoria, which was, so we peaked, we went back to normal because the restrictions were easing, and then we went, you know what, we're having a second wave. Restrictions, 4-stage lockdowns, bang, we're back in again, and everyone got depressed. And now look what's happened since. Now that with all the announcements with the budget and also the restrictions easing, look what's happening in the index. It's going back up again. So, you know, we had a kind of a reversed U recovery, I guess, or a W recovery, or head and shoulders, whatever your pattern technical analysis is. New South Wales, bottom was the first or the fourth, so fourth month of the year, and then after that, recovery, and then sideways, and it's going to go up even more. Queensland's the same thing. So in Melbourne, the bottom was June, July, arguably. In Victoria, because remember, Victoria is regional areas as well, and regional areas boomed. So, you know, April, May, about there. WA, same thing. South Australia, it's definitely, we've passed the bottom, you know. So now it's either things in a lot of major capital cities are going to go sideways because of unemployment, because of uncertainty, but it's not going to go down any further. Northern Territory and ACT. Now, ACT is actually doing quite well because it's all public servants, so they've actually been unaffected. If anything, they're working more hours probably. Also, weekly rental demand has started to recover. So we had a low point, and now it's going back up again as people start to move around, and there's less stock on the market because there was lower volume of sales, so hence lower volume of settlements, and supply is increasing. Mind you, it's interesting that rentals are going up because we have had our borders shut in Melbourne, and we haven't had that 97,000 immigrants that came over last year. When the borders open up in Melbourne again, which I think will be June next year, hopefully, I think the vaccine will have to be initiated before we truly go back to normality. You're going to have about 150,000 people trying to get into Melbourne, and that's going to create a massive boom in the property market. October 19th, so this is a weekly search report from the real estate .com website. So this is a really good indicator because that's majority of the sales are actually from that website. So you can see there on the 1st or the 4th, you had people virtually not, so this is for year-to-year change of searches for properties for sale. Most people, when they buy a property, they go to realestate.com. So you can see that on the 1st or the 4th, that was the bottom of the market. People weren't searching, and then after that, they started to search again for real estate to buy. And I mean, 99% of all sales virtually go through realestate.com now. So domains good. Is a distant second. So you can see that once again, that's the national average. And if you can see there, properties for sale for Victoria, same thing. April, you know, so 1st of the 4th, between the 1st of the 5th, that was the bottom of the market. And then we peaked, and then we went down again because we went into the second lockdown. People were going, oh God, second lockdown. And I think it's gonna be a third one, but anyway, I'll talk about that later on. And then we've got the national average for properties for rent. Same thing, bottom of the market, and now everyone's back renting, thinking, yeah, I want to change where I live. I want to live here, I want to live there. Now, this is a huge one. The responsible lending laws are to be terminated by March 21. This is a major, major game changer. Do you know, I always talk about the four most dangerous words in property investing is this time it's different. I'm telling you, this is something huge. This is not a small thing. this is going to have more impact on the market than anything I've seen since the GFC. It's going to be massive. Let me explain and unpack what it is. So the scrapping of the restrictive responsible lending guidelines, which were introduced in 2009 by Kevin Rudd, by the 1st of March 2021, its potential immediate impact on the Australian property market and why it's a real game changer. So what happened is we had the GFC, we had irresponsible lending, people were throwing money at people that were on, especially low docs, no docs were available, self-certified income, people were lying on no docs. Yeah, I'm on $500,000 a year, here's a letter from my accountant, you know. And they were making 50 grand a year. So Australia said, you know what, stuff this, we're not going to follow down the path of the US. We're going to introduce a national consumer credit guideline where there has to be a limited amount of disclosure. We have to know the income and the assets and liabilities of individuals before we can give them money. So they initiated this, which is the responsible lending guidelines, where the owners of checking living expenses and assets liabilities, the burden of that fell with the lender, not the individual, which is kind of a form of socialism, because really, you know, we're responsible adults. We know how much we earn and we know how much we spend. We know whether we should get the mortgage or not. And if we fail, if we go bankrupt, then it's our fault. You know, I mean, let's stop, you know, this kind of extreme analysis of what we're doing. So in 2009, there was an introduction of the National Credit Consumer Protection Act, which came into effect. In 2017, it worked really well. ASIC commenced federal court proceeding against Westpac. Westpac was basically using another system of giving people money, which was the household expenditure measure, which I will cover in a second. 2018, Westpac expense categories for mortgages applications increased from 6 to 13. So there's more hurdles, more categories to satisfy to get a loan. The federal court refuses to approve $35 million penalty for Westpac imposed by ASIC. So ASIC penalised them. They lost in court. There was a Royal Commission, and the Royal Commission was very important because it said, ASIC, you misunderstood what the household expenditure measure was, and it can be used. And the Justice Param dismissed ASIC's allegations against Westpac on 2 counts. And then Westpac increased its expense category from 13 to 18 anyway. So what actually happened is the household expenditure measure, HEM, is a measure of what families spend on different types of household items, calculated quarterly by Melbourne Institute of Applied Economics and Social Research. This is a very important thing, because what happens is, so what are the laws? Let's talk about them and how it impacts lending. And I'll give you the real summary of what it is. The Rudd Labor government tightened the responsible lending laws in 2009 following the GFC. The laws required lenders to make more of an effort to figure out whether the would-be borrower could afford to repay their debt. The responsible lending obligations had 3 steps: make reasonable inquiries about the borrower, also make preliminary assessment to check whether the proposed credit contract is unsuitable for the consumer. What? We know whether it's unsuitable or not, and provide written assessment that credit contract is not unsuitable. There's always been a requirement for the lenders to make sure customers can afford the loan. The tightening of responsible lending guidelines meant the lenders were required to take a much closer look at applications, at the applicant's actual living expenses, instead of using standard industry benchmarks. And the industry benchmark in Melbourne, for example, was for an individual was about $18,500 per year in living expenses, for a couple $37,000, $38,000. Banks took longer to process home loans, as they had to assess pay slips, banks, and credit card statements to get the full picture of the borrower's expense situation. The winding back of these lending obligations may mean it's easier and quicker to get a loan once it comes into effect in March 2021. Now remember, if you haven't got a mortgage, if you're a plumber or a tradie, you might just pay yourself a minimum income and then leave the rest in the company, or, you know, run your cars and your expenses through company, get creative with accounting. But once you get a mortgage, your spending habits will change. You're going to prioritize your mortgages. And this is the problem with this way of assessing people of what they actually do. And people were getting rejected because they were spending too much money on takeaway food every week, or going out, you know, to nightclubs and to bars and getting pissed and spending, you know, $400 on drinks. But I can tell you now, if they had a mortgage, they would have not gone out that much. So it's a stupid way of analysing people's serviceability, because it's assuming the worst. You've got no mortgage, you've got money, and they assume that your spending habits will remain the same when you have a mortgage. And that's not the reality. The reality is you will actually alter your spending habits, and you will factor your priorities, which is always your mortgage. And that's exactly what humans do. When they haven't got a mortgage, they spend more on clothing, on going out, more expensive holidays, more expensive cars. When they have a mortgage, that takes priority over everything else. And then they start cutting back and then not go out as much and spend less on takeaway food, buy cheaper cars, budget on holidays, not take as many holidays before, because they don't want to go into bankruptcy and lose their house. And that's what the banks fail to understand. What does it mean to the borrower? Lenders may not be required to take, so the new changes will go back to the pre-GFC period, where borrowers will basically say, look, this is how much I'm spending per month, and the banks will take it at face value. Banks may not complete a forensic examination of such as bank statements, and there will be less requirement of paperwork. There'll be more flexibility for lenders to approve good customers who in the past may have been declined because the lender didn't believe they could afford the loan. You have a faster and easier access to take out mortgages, refinance home loans. If you work with a mortgage broker, you'll still be protected by the best interest, which is beautiful, duty that comes with an effort from January the 1st, 21. You have to continue to provide accurate information about the ability to repay a loan. It puts the responsibility right back on you to be safe and sensible and how much you borrow, and there are other variables. The responsible lending laws are being reviewed because maintaining the free flow of credit throughout the economy is crucial to the Australian economic recovery plan to rise out of the COVID-19 recession. Absolutely correct. By winding back the regulation, it does mean that ASIC will not have oversight over lenders, and APRA will be solely responsible for ensuring lenders maintain standards. And APRA's a toothless tiger, they won't do anything. Actually, ASIC's a toothless tiger. I don't even know. APRA's like a panda, a lazy panda, just sleeps all day. These changes are being recommended as responsible to ongoing concerns about the interpretation of responsible lending laws. It is believed that lenders are being too restrictive, they are, in offering new credit out of concern for action by regulators. See, it's more of a concern about the regulators punishing them rather than the actual person defaulting. The industry is backing the lending changes, and it may speed up decisions for Australians trying to obtain new loans. There's a suspect the principles behind responsible lending will not change, rather the manner in which the lender assesses the applicant will. Whilst responsible lending regulations have been in operation since 2009, over the last couple of years, the Royal Commission, ASIC, case against Westpac, have seen lenders effectively conduct forensic audits of applications' living expenses, with no room for application changing the lifestyle if they do get a loan. And the judge actually said, he made an example of someone who's working full-time, and if they haven't got a mortgage, they'll go out and buy a steak for, Wagyu beef for $60 and have a nice Shiraz. But when they have a mortgage, that might not be something they can do every week. They might have to cut back on their dinners and dining habits to make allowances for the repayments. And that's the inflexibility of what the banks have been operating under for the last decade. So what's going to happen is there's going to be an ongoing requirement for consumers to provide information for applications. It may just be the level of detail and the amount of information required will be reduced. The major change is the lender will no longer be solely responsible in the transaction. There will be stronger requirement for consumers to understand the implications of taking out new finance, which is you sign a declaration form saying, yes, I understand I'm going into debt. I understand I'm responsible for the loan. The consumer will have to understand that they may have changes to the lifestyle. The mechanics behind this are yet to be determined. Now, what will happen, guys, is it's going to go crazy. All the self-employed people, the tradies, the business owners that are paying themselves the minimum wage, hence they can't service a loan. Let's say you're making 200 grand a year, but you're paying yourself 60 grand. Those people go into low doc loans. There'll be an accountant's letter, and they'll start borrowing money for the first time. It's going to open up a whole segment of the market that before could never get into the property market. And because banks won't check your statements, they'll just get a letter from the accountant. And I'm talking about those lenders like Pepper Home Loans, Liberty, all the non-conforming lenders. They're going to absolutely clean up. So you're going to see a whole sector of the market go in on low doc loans, but they'll be able to borrow millions of dollars that they couldn't previously borrow. It's going to have a massive immediate impact, not in March, by June, July, because it'll take 2 or 3 months to settle a property, but definitely by the end of the year on the property market. Huge. And there's the word spreads. As lenders become more flexible with products and new products become created, it's going to open up a whole sector of the economy. mainly self-employed people, people with income generated overseas. They'll be able to borrow money and they'll be able to buy properties where they previously couldn't. So this is going to be a game changer from March next year. I think the full effect of this won't be felt next year. I think it's going to, banks are very slow. Even the most creative banks are very slow to change. This will be something that will be really felt in 2022. And then there's going to be a whole suite of products which will be brought back to the market. So the low doc, no docs is gone. No docs is never coming back. But low doc products, where it's just income certification, letter from an accountant, 100 points ID, and you're borrowing money. And because interest rates are so low, you're going to be borrowing money at 3-4% per annum, which means the property is virtually cash flow positive. See, back when I was in lending 10 years ago, we're doing, mainstream lending was 7%, non-conforming was 8-9%. Now it's virtually, it's ridiculously cheap. So you're going to see a massive amount of people going into the market. Those people that have retained their jobs through the COVID-19, they're going to be buying up next year. Otherwise, you've got to pay tax. Big game changer. Many people talking about it. I think it's going to have a massive impact on lending long term. And I don't think it's going to be revisited again, because analysing those low doc loans, they've got a very low default rate compared to what was expected originally. So huge thing. So you're going to see a massive correlation between this introduction of the easing of these responsible lending guidelines and new loan applications. So huge thing. Newly advertised properties, rent for sale. So we can see there in October, they're picking up as well. So they're up. People are starting to list properties slowly, and there's definitely rentals also. Mortgage activity, there's a spike. There's a very small spike already where people are coming back into the market. And you can see that this is in 2020 versus 2019, 2020 being the blue line, 19 being the grey line. You can see there's a difference already in more mortgage activity, even though we have a restrictive environment. People are coming back into getting mortgages. And you can see there the loan purpose, 63.3% are refinancing. So they're trying to save money in order to get a lower rate, but they're also refinancing. A lot of them are refinancing and getting a line of credit or regional facility to buy an investment property. There's also 24.59, 25% of loans are for the purpose of buying another property or brand new property, and construction 12.34%. So we're going to see this is the beginning of the next property cycle. We're going to see the slow trickle through of new mortgage applications increasing, and I think by March next year it's going to increase even further. If we have a good COVID-19 result, guys, and I think we're just going to run out of time this year to see any significant impact, because by the time we get to November, as you know, we're all in Christmas mode. We don't give a shit anymore, right? So I think what's going to happen is a lot of people are going to sit on the fence line, especially if they haven't invested before, they got one property, and ride it out to Christmas, and then make a decision next year to, when the market opens up in end of January, they'll go back in. When the market opens up in March for the changes in the responsible lending guidelines, another sector of the market is going to go back in, and it's going to create even more momentum in the market. Now, because of that, that's going to create another property, another property cycle, the beginning of the next property cycle boom. Let's talk about the mortgage stressed suburbs and where they are, because this is another thing that I want to show you. This is basically the numbers and the volume. If you look at Victoria, all borrowing households, we got 986,000 properties that have borrowed money. In stress, by the way, this is in stress means also deferred payments, because when you're deferring payments, you got to say we're in stress because we haven't got a job. 437,000. Now, there's information that came out just yesterday saying that half of them already, when they go back to work, are going to be able to meet their repayments. Total risk default, 25,000. So the average default is 2.6%, and the average stressed properties are 44.2%. Now, where are they concentrated? This is where they're concentrated, the segment by sector. Young growing families, that's the biggest sector, 73.4%. So fringe suburbs, guys, I'll show you the maps. Battling urban is 66.4. Disadvantaged fringe, 61.7, right? So the worst areas that are further out. Executive professionals, only 36.3. Multicultural establishments, 35.7. Mature stable families, 33. Suburban mainstream, 32.5. Rural family 27, stressed seniors 18, young affluent 17.1, and wealthy seniors 16. Grand total 40%. Remember, these are properties that are on pause, mortgages that are on pause, deferring interest repayments because they've lost their jobs. If you look at the volume by postcode, you have places like Ballarat, which has the disadvantaged fringe, has a high spike. So people want Centrelink allowances and low-income jobs. Hoppers Crossing, Tarneit, multicultural establishment. Mackinnon, Roxburgh Park. Rowville. You have also in Melbourne, Cranbourne, wealthy seniors, so retired people. Frankston, Battling Urban. What else do you have in Melbourne? Ipswich, you have always, I talk about this on Melbourne, obviously, but as you know, one of the worst areas you can invest in. Doreen Mernda, disadvantaged fringe. Epping, Battling Urban. Sunbury, disadvantaged fringe. And it goes on. And the thing is, these are the same suburbs I always talk about in my YouTube videos about areas that have the lowest income demographics, highest crime rate, and also the highest mortgage default rate. So if you look at, this is rent stress as well, which is not that important, but Victoria's got 460,000 rent stress properties, which is 43.8. So these are tenants that couldn't pay rent. By the way, all the properties that I've sourced at Investors Prime Real Estate, since I've opened the company 6 years ago, we haven't had one tenant that has not paid rent to my clients' landlords. Not one of the properties. Not one. Can you imagine? I was surprised. I thought it'd be at least 5%. So this is sector by sector. So basically what we're talking about here is we're talking about areas in Melbourne that are the blue. These are the mortgage stressed suburbs, which is the fringe suburbs, the new house and land estates, or the so-called growth corridors. And you can see the light blue sections are the least affected sectors. So you can see that on the left-hand side, you've got your Truganina, Tarneit, Point Cook, and the surrounding estates. And then you got Berwick, Pakenham on the bottom, and at the top it's cut off, but you got Roxburgh Park, South Morang, and all the other suburbs. They have the highest level of stress in Melbourne, which means, but the banks will allow them to basically default, as I mentioned before. Nothing's going to happen there. Are there going to be bargains? Potentially, but long term, you don't want to invest in there anyway, so it's irrelevant. Melbourne suburbs show signs of heightened mortgage stress. Tullamarine Broadmeadows on the outskirts of Melbourne was the only non-Queensland location to make it to the top 10 list of mortgage deferral spots. So mortgage deferral, you can only defer a mortgage if you are stressed. Obviously, you got your income is lower than your repayments, which means you're sitting at home, you're not working. However, several other Melbourne fringe suburbs have shown signs of heightened mortgage stress in May when the data was collected. So Wyndham, Casey South, you've got all the Melton, Sunbury, Bundoora, all the normal suburbs that we always talk about. And this is another map of the 20 Australian postcodes with the most mortgage stress. So in Melbourne, Victoria, you can see there it's Ballarat East, Ballarat, Sydenham, Melbourne City, Berwick, Narre Warren South, Pakenham, and then to a smaller extent, Roxburgh Park, Cranbourne, Tarneit, also. So I keep mentioning these same suburbs. There's my postcode and region. So you can see there, it's the same thing. So for Melbourne, Berwick, Narre Warren South, Sydenham, Pakenham, Cranbourne, Tarneit, Roxburgh Park. So these are not, I'm not bagging these areas, guys. They're good areas to live in for families. I'm just saying these are areas you don't want to invest in because of the clustering of demographics. So also what we have is in terms of loan applications, so new home loans have jumped 12.6% in August. So there's a huge, Australians are flooding into the property market in record numbers despite the country suffering its worst recession in the 90 years. So this is something very interesting because first home buyers are flooding into the market having responded to the government support measures. The number of new home loans commitments for August, well, first home buyers has hit the highest level since October 2009. More than 12,000 first home buyers settled home loans in August, up from 10,451 in July and 8,961 in August 2019. So the first home buyers grants and loans are working really well, which is going to fuel that bottom part of the economy as well. This surge in interest comes after the federal government announced home builders grants with $25,000 in June and $10,000 places for the first home loan deposit schemes in October. So you can see that the volume is massive. Value of new home loans, owner occupiers in August, 16.3 billion. Monthly change, 13.6%. Increase of 29.2%. That's huge. Investors, there's 5 billion in August in investment lending, 9.3% in monthly change, so increase in the month, but year-to-year change negative 4.6, so less the same time last year. So that's still very healthy numbers, guys. So that means that investors are less prone to invest, but first home buyers and owner occupiers have gone up, have increased the amount of loan applications by 30% same time last year. Owner occupiers, number of new loans, and this is from October 2009, 12,302, monthly change 17.7 and 37.3%, so it's accelerating. This is from the Australian Bureau of Statistics, released on October the 9th, 2020. So you can see there from that it's actually increasing, and it's it means that more people are now starting to look at the property market seriously. They realize we've passed the bottom and they're going in. The evidence continues to mount. The Australian housing market is going through the COVID-19 pandemic largely unscathed. It's quite remarkable that we're in the midst of the biggest economic downturn in our generation, yet lending for homes is pushing up prices higher and accelerating at pace, which is really cool. The other thing that's happening, which is very interesting, is Australians are holding on to their homes in the best suburbs twice as long as they were 10 years ago. So people are not selling houses every 7 to 10 years. And I had a suspicion when I wrote my book, Australian Real Estate Investing Made Simple, that people are holding on to houses longer and longer. Because in the suburb that I live, the average house turns over every 20 years. No one wants to sell in the eastern suburbs, in the area that I live in. And so what's happening is people are holding on to houses longer and longer, and ownership is going down. So people are not turning over properties every 7 to 10 years. In fact, if you look at Melbourne, Monash, 17 years, the average period for holding a house. Whitehorse, 16.2. There's a lot of areas where people are holding onto houses for 15 years. And there's even suburbs where people hold in specific streets, where people are holding onto houses for 20 or 30 years. They're not selling them. So what you have is you have got a combination of people not selling houses, and this theory of baby boomers dumping all the 4-bedroom houses once their kids go, it's all baloney, guys. Baby boomers are staying put. They've got their houses perfectly sorted. There's a lot of baby boomers that I know of live in the 6-bedroom houses, 5-bedroom houses in the eastern suburbs and the Bayside. The kids have gone. They got four empty bedrooms, massive blocks, 1,000 square meters, and no inclination to move anywhere, ever. And this is what's creating more pressure on stock. So this theory, this economic theory that baby boomers have a 5-bedroom house on 1,000 square meters with 3 kids, kids go to uni, they get married, suddenly they look around, the house is empty, and they think, oh, it's too much to clean. Bullshit. No one's selling anything, guys. They are cleaning. They're cleaning, they're doing mortgage withdrawals, and they're traveling overseas and keeping their house exactly where it is. So people are not selling. If there's a medical condition, if they've got knee operations or hip replacement where they can't maintain the property, yes, they sell. But if they're healthy, and a lot of people past 65, they're healthier now than ever in the history of humanity. They're going to gyms, they're taking NutriBullets, they're living longer and better quality lives. The healthier ones are staying put. And I've seen this in places where I've got investment properties in the eastern suburbs, and I've gone up next door neighbours, and there's 65, 75-year-olds with no kids living in, 1,600 square meter blocks with 5 empty bedrooms, and they go, mate, we're never selling. We are never selling this house. We've got it perfect, and we're going to die in this house. We are not moving. See, the thing about old people is they don't want to move. It's traumatic. Number one is they know the area, they know the house. Everything they want to do to the house is probably done by then, right? So they got the garage is perfect. They got everything perfectly done. The kitchen, everything's perfect. But the biggest thing is all people do not want to put their whole life into boxes and move to a small townhouse, unless financially they have no option, right? People don't understand, and economists underestimate the emotional trauma for a 70-year-old to put the whole life into boxes and move to a 3-bedroom townhouse. It's just a theory, you know, and this is why you have to go to Monash and get your money back, because all those textbooks are all BS, right? It's just all theory. And this is why these theorists sit there and they do all these economic research and it all unfolds. And I love the fact that the baby boomers now, because in the 90s, they should have all been left now. They should have left Caulfield and Elsternwick and Brighton. They should have been all empty suburbs, right? And young people with families should have come in. No, they don't care about those families. They're not moving. I love the fact that they're not moving. All the economists were completely wrong. These baby boomers are not moving. I freaking love it. It's so funny. It just, every time I think about it, it's hilarious. Why should they move? They work their asses off, right? So you tell a 7-year-old to move after 40 years in the workplace. No one's got the right to do that. They can stay wherever they want. They've earned their right to be there. If they've worked their asses off and they've got a massive house on 1,000 square meters with 5 bedrooms and the 4 bedrooms are empty, so be it. It's a free country. We're living in democracy. We're not in Russia. We're not in Poland under communist regime. You know, so people can't tell you, oh, you got to move because a new family's coming in. Stuff the family. Let them live in an apartment. I don't care. So, and that's the way it should be, you know. And if they want to buy them, they can buy them out. And if they don't, they can stay where they are. So think about this in terms of wrapping up all the topics for tonight slowly. I know I've gone over time a little bit, but it's all good. Every time we had a massive correction in the property market, whether it's negative gearing introduction in 85 or negative gearing reintroduction in 87 or whatever it is, the 87 stock market crash or the dot-com bubble bursting or the GFC, it was followed by a massive property run because the money has to go somewhere. And 60% of our wealth in this country is locked up in residential real estate. It's not going anywhere. And it's capital, majority of it is capital gain tax exempt. So that money is never leaving that property market. So we're once again at that critical point. We're about to go up in the market's about to turn, and for all intents and purposes, already made a turn. But we won't know until probably January, February next year because we're always looking back at data. I think psychologically we've made a turn and consumer sentiment's back. What I'm concerned about, and I'm just going to be honest with you guys, I'm talking to you like a friend. I'm not talking to you like some economist. I'm concerned about the dickhead factor because what's going to happen is what happened in Sydney and Coogee Beach, right? And you got to understand when St Kilda beaches open up in December, all the dickheads, all the vegan alternative Fruit Loops and snowflakes that live there are going to go to the beaches because they think it's a conspiracy theory, it's Bill Gates, it's population control, and we're 24, we're not going to get affected, right? Stuff the old people, they can die for all we care. We just want to party, yay! You know, so we're going to go to the beach and get pissed and infect everyone else. And I'll tell you now, Melbourne, especially St Kilda and Williamstown, is a breeding grounds for complete dickheads. There's more of them in those two suburbs than any other suburb, unless it's western suburbs of Sydney. And it just takes one of these people to go out there and infect 20 others. So I have no faith. I have faith in 99% of us because we're responsible adults. You know, we do what we're told, and people have sacrificed massively. People haven't gone to funerals. People have not cancelled weddings. I mean, people have not seen their parents pass on in hospitals. You know, we did it hard. The Victorians did it hard, but there's always a dickhead that thinks they're above the law, that it's a conspiracy, and it doesn't affect them. And they're the ones that always stuff it up for everyone else. And that's what's going to happen when we open up in January, February. We're going to have a third wave. It's going to go out of control. The only option we have is vaccination, okay? And then you're going to have those people that say, vaccination, it's all conspiracy theory as well. So I think I have no faith in us to defeat the Corona-19 virus by self-isolation. I have zero faith in us. In me, I have faith. In you, I have faith, but not dickheads and the vegan alternative people that live in St Kilda, because I see them every day. I don't grow up in St Kilda, guys. I love St Kilda, by the way, so don't send me emails. I grew up in St Kilda. I went to St Columba's School in Elwood and Christian Brothers College in St Kilda, all right? So don't talk to me about St Kilda. But I've seen the idiots that live there. And it's always for 1,000 responsible people in St Kilda, there's that one idiot that will stuff it up. So I think what's going to happen is we're going to ride out next year. I think it's going to be a flat market. I think investors are going to go in and snap up all the bargains because they already have. By June, we're going to be at the bottom. Hopefully the vaccination will kick in between June and December next year. If we need two things to happen for the market to really go up in value, we need the vaccination to be introduced and administered en masse, and we need the borders to open up to overseas immigration. When that happens, you're going to see the beginning of the next property cycle. So whether it happens in 12 months or 16 months, it's going to happen. But you need those two factors, in my opinion, to really go up, and the market will do 10%, you know, back to double digits. You know, beforehand, I wouldn't be surprised if from now to June next year we go sideways, and if we have these idiots during Christmas period or January infect and create a spike in the numbers, I wouldn't be surprised if we go into lockdown again. So if you see them in St Kilda with the purple hair and crystals hanging off their neck, drinking almond milk tofu syrup with pixie dust, tell them to stay home. You know, don't ruin it for all of us. Okay. And I see them around St Kilda. So it's a matter of, you know, am I positive, negative? I'm a realist. I see the glass for exactly what it is. I see a glass as it's half empty, and I drink the water. That's the most important thing. For you guys, you know, you have to understand one thing. Your indecisions in your life are as costly as the wrong decision. So you either react or respond. 95% of people are reactional. 95% of Australians didn't invest this year and won't invest this year because they're scared. And they're scared, and they've got the right to be scared because they've got no knowledge. Their level of awareness is so low, even if they invested, they probably will invest in the wrong property and lose money. So I'm not blaming people for not investing. Those that know what they're doing, those with an extremely high level of awareness, know exactly what to buy. They responded and they bought bargains, and they made 100 grand already. I've got 6 clients that made over 100 grand already with properties that I've sourced for them, because they bought them for 750, and they're worth 895. So it's one of these things where one or the other, you're going to be putting yourself into one category. The more education you have, the more reactive you become, the more responsive you become. Successful investors are responsive. They're the 5% and then the 1% of the population. Majority of the public, complete reactional people. Media is negative, they're negative. Media is positive, they're positive. The main thing is to keep the main thing the main thing. And the main thing is this: where is going to be real estate 25 years from now? Because remember, this is a long-term game. The average homes in Australia will cost 6.3 million in 25 years. Bombshell study has revealed. Projections show median house prices will reach the figure in Sydney by 2043, up from 1,030,000 today. In 23 years from now, that is, because these figures came out 2 years ago. Aussie Home Loans and CoreLogic survey predicts average home prices hit 5.8 million in Melbourne, 2.9 million in Canberra, 2.5 in Perth, 2.3 in Brisbane. So if you knew every house in Melbourne, the median price would be 5.8 million in 2020, in 2043, 23 years from now, what are you going to do today to make sure you get as many of those properties as possible? Because remember, 23 years will go like that. Remember, the GFC was 2008, guys, 12 years ago. It feels like it was yesterday. And if you've bought 3 or 4 properties, you're laughing. And people like myself with large property portfolios, do you know how much security and confidence I've got during big places like when I'm locked down? I'm locked down in a big house with a pool. Nothing affects me. You know, I got my commercial grade gym. I've got my Italian coffee machine. I've got a cinema room with surround sound. I'm living in luxury. Like, nothing really affects people like myself who've taken the steps to build up wealth and have those buffers in place. And that's what I want for you guys. And that's why I do these webinars and videos, because number one, I want you to take action. It doesn't have to be through me, as long as you're taking action. Number two, I want to save you from making mistakes and not invest in these areas where people keep investing in. So have a look at the median price. What if this was a crystal ball? What if this is the future? Where in Sydney, an average house is 6.3 million from 1,030,000 today. What are you going to do to make sure you get many of these houses? You know, Perth 2.4, Melbourne 5.8, Hobart, Greater Hobart 2.2 million, Darwin 2.2, Canberra 2.9, Brisbane 2.2, Adelaide 1.9. Can you imagine $2 million in Adelaide? Now for $2 million, you can buy a whole street and then throw the church in. I'm kidding. Don't send me emails, guys, from Adelaide. Okay, don't send it to me. Be fearful when others are greedy. Be greedy when others are fearful. Warren Buffett. Top 1% of Australians own more wealth than the bottom 70% combined. Oxfam Australia has released a new report revealing wealth inequality is still on the rise. Guys, wealth inequality is never going to stop. You just have to make a decision which part of the fence you're going to be in. And it's just hard work. You know, it's not luck, it's hard work. The report came out, new data shows wealth divided in Sydney is becoming increasingly pronounced. Doctors and lawyers clustering in neighbourhoods close to the central business district, and essential service workers such as police, nurses and teachers being forced to settle in outer suburbs where property is more affordable, as reported by Fairfax Media. The report relies on data from Credit Suisse, shows the level of wealth held by Australian riches 1% grew 23% in 2017, up from 22% the year before, on top of 1% owning more wealth than the bottom 70% of Australians combined. It shows the wealth inequality in Australia has been on the rise over the past 2 decades. The gulf between the amount of wealth held by the top 1% and the bottom 50% is in the greatest ever over this period of time. So remember, the wealth, the richer are getting richer and the poor are getting poorer. And the difference is how much real estate you own. Majority of wealth is locked up in real estate for the rich and businesses. The wealth share held by the top 1% of Australians has been growing almost continuously over the past 2 decades, while the wealth share held by the poorest 50% of Australians has been falling. So it's crazy. Over the decades since the global financial crisis, the wealth of Australian billionaires has increased 140% to a total of 115.4 billion last year. Yet over the same time, the average wages of ordinary Australians have increased just 36%, and the average household grew by 12%. Remember, inflation is 3.75. The rich are getting rich, the poor are getting poorer. And the reality is that it goes down to real estate is the key determining factor. So you just got to make up your mind where you're going to be. Top suburbs to invest in 2021. So let me wrap up now. I'm now going way over time, so I appreciate you guys sticking by, which is awesome. Geez, full house still, so that's good. Suburbs upmarket. So these are if I think the Bayside's going to go first. The eastern suburbs are going to take a little bit longer. Bayside's going to be more stronger this property cycle. I'll do another video and tell you why. I'm not going to cover it today. Which areas would I invest in if money was not an issue? Albert Park, #1, Port Melbourne. St Kilda West, Balaclava, St Kilda East. Brighton is very expensive, I know, but definitely Brighton East if you can't get into Brighton. Bentley East, Elwood, Hampton, Sandringham, Blackrock, Balmoral. That's Bayside upmarket. That's like #1 pick if you're wealthy, if you have no budget. If you're entry level, all right, Cheltenham, Hyatt, Mentone, Mordialloc, Aspendale, Edithvale, Chelsea, Bond Beach, Chelsea Heights, Carrum. Don't go Seafood, don't go Frankston. It's not going to happen. Seafood's not going to happen, guys. Forget about Seafood. Upmarket eastern suburb, Mont Albert North, Kew, Canterbury, Camberwell, Surrey Hills, Hawthorn, Balwyn North, and Waverley. Okay, and then entry level, cheaper properties, Box Hill North, Heidelberg Heights and Heidelberg West for gentrification suburbs, so areas that are going from bad to good. Blackburn, Burwood East, Mitcham, Bayswater, Doncaster East. So these are townhouses around 750, 850, 950, okay, for 3-bedders. So these are the areas that I think will do really well this property cycle. So if you buy them now cheap, they're just going to go up in value by the time we hit the next growth cycle. If you don't know how to get started, watch this YouTube video that I did a while back called Top 10 Fundamental Things You Must Know About a Suburb Before You Invest There. The fundamentals have not changed, guys. It's the same fundamentals. So if you watch that video, it's 35 minutes. It talks about the 10 things you need to, it's like a checklist of what you to tick before you invest into an area. Some of the areas that I've got still stock in that's been priced 2 years ago at a very different market. There's 9 townhouses left in this project in Balaclava. There was 26 townhouses originally. They're from 855. All the 855 are sold. There's 950 now to 1,095,000. This developer is very doesn't want to sell them. He's happy to complete them and auction them off at completion. There's no pressure on this developer at all. That's why they're still available. He doesn't care. Very good value opposite Yeshiva College in the Jewish Orthodox area. Phenomenal product. Probably the highest growth development that I've got at the moment that I've sourced. By the way, I've got over 4,000 properties that I've got access to, so I can choose which properties to source and offer to my clients. Great location. Balaclava is just near St Kilda Reefs. People don't even know Balaclava exists. They call it St Kilda Reefs, but it's actually Balaclava is a separate suburb. So this is just near Hotham Street and Inkerman Street. Great location. Carlisle Street around the corner. You got the beach, shopping, amazing. Transport to the city, cafes everywhere. Amazing location, 10 out of 10. There's one townhouse left in Lancock Street, Brighton East, which is a phenomenal development, 1.895 million. They're the most expensive ones. The other ones are cheaper. So these are upmarket townhouses that I source for clients. They, if you're earning the right amount of money and the right amount of tax, they're cash flow positive from day one with negative gearing. So phenomenal properties overlooking Lancock Park. Brighton East is going to boom. It's already started to boom already. So it's just going to go strength to strength, and the land's gone up a lot in the area. So I know developers that live there and they develop there. They're telling me everything that's happening with blocks of land in that suburb. This is in Brighton East as well. I've got a development there which I sourced at the beginning of this year, 10 townhouses. There's 2 left in that project. 2 bedders are going for 1,020,000 and then 3 bedders for 1.15. There's 1 of each left. So great project, and I negotiate 100,000 off each townhouse with the developer. I have exclusive authority over this project in Brighton East. So 10 townhouses, great location, great schools on the beach, phenomenal product. Ground floor bedroom, double lock-up garage with a laundry, and upstairs 2 bedrooms with 2 en suites and a small balcony. Phenomenal product. So can't go wrong with this kind of product. Gentrification suburbs. So this is an area that's really high in crime now, that's undesirable, going into a really cool suburb. Number 1 in Melbourne, Heidelberg Heights, Heidelberg West. I've done a video on these suburbs before on YouTube. Ex-housing commission area, but 9 to 12 k's from the city, surrounded by very affluent eastern suburbs. I've got a project that I've just sourced now in number 25 Redwood Street, Heidelberg West. Consists of 4 townhouses. The front 2 are 2 bedrooms. They're 619,000, and the back ones are 3-bedroom townhouses with double lock-up garages. They're 719,000 and 729,000. So they're available if you wanting to jump onto that project. That's going to do really well. They're very cheap compared to other projects that I've sourced in the area. I think they're about 50 grand under market. That's what they look like on the inside. That's the location there. You can see the 25 Redwood Street, very close to the Heidelberg Hospital precinct, and surrounded by affluent suburbs in all directions. It's a phenomenon that there's these 2 little suburbs that were predominantly housing commission and surrounded by middle-class upmarket suburbs in the eastern suburbs of Melbourne, which is the best part of Melbourne. As you know, you've got the best schools there. The richest people live in Toorak, obviously Hawthorn, all those suburbs. So this is basically cheap. It's still nasty. You still have crime. You still got to lock up your cars at night. But that element, those people that are renting those housing commission units, they're getting priced out of the rental market. They're all going to disappear in the next 10 years. And people that buy them now are going to clean up a lot. So once the area changes, guys, it's too late. It's like Altona now. You've missed the boat on Altona. Altona was good 15 years ago. So this is rough now. You want to buy when it's rough, not when it's good. When it's good, it's game over. The money's been made. So if you want to secure one of those properties or more information, floor plans, I've got everything. It's online, or you can just give me an email and I'll send you all the information. But you can see they're really good configuration. Have a look at the 3 bedders, double look-up garage or carport. But look at the land around those. It's massive. So there's only 4 on the block, and I'm going to have future projects like this available. It's just that these developers now have shelved all the projects and they're not creating anything until January because they don't have the hassle. But have a look at number 3. Phenomenal courtyard, phenomenal location. You got some of the best schools in Melbourne within 10 minutes drive, and 729,000 for 3 bedrooms in Melbourne, 12, 13 k's from the city. Can't get better than this, guys. Best option ever. So, massive block, only 4 on the block. So you got a land component, cash flow positive from day one. That's the price list. And if you want to email me, conrad@investorsprime.com, I can give you more information. Or if you jump onto my website, investorsprime.com.au/Heidelberg-West-townhouses, or go into past projects. It's the first development. You can upload all the information. You got the brochures, their plans, rental appraisal, depreciation schedules, everything. Or just email me directly. So what's the next step? The next step is also I want to invite you guys For those who are interested in building wealth using townhouses and properties that I source, feel free to make a time to see me and book in a 60-minute strategy session with myself on the phone or Zoom. I've been doing a lot of these lately, and I'm only offering these for a short period of time because any live events since March. So I'm happy to chat to people. I don't work many hours, guys. I only work Monday to Thursday. I have a long weekend every weekend. But yeah, I've got limited spaces for 60-minute strategy sessions with myself, where I can do a bit of a plan, work out where you are, where you want to be, and give you some feedback about how to get there in the least possible time frame and the least amount of effort with the maximum result. Remember, failing to plan is planning to fail. You've got to have a plan. And most people's journey to building wealth is from A to B like that. They go around in circles. They waste so much time. Sitting down with an expert like myself, and look, 25 years in the same industry, guys, 25 years I've been doing property. Since I was 18, I'm 44 now. I've learned a few things. Do you know what I mean? I've been around the block a few times. There's not much that can surprise me now. Dealing with the same market, dealing it from a real estate agent's perspective, a mortgage broking perspective, a banking perspective. So I can save you time from making mistakes. You get an hour with me, no obligation. You can book it on, just by emailing me. I'll show you what the process is, and I'll do a bit of a plan. I'll tell you what's possible, but it's only for people who want to build wealth by buying brand new properties, established or completed, or off the plan townhouses in Melbourne's top highest growth suburbs. If you want to do developments, if you want to do renovations, don't book a time with me. I'm not teaching that stuff. I just teach buy and hold, passive accumulation, blue chip areas. So no hassles with tenants, blue chip areas. I'll give you an introduction to my mortgage broker, my accountant, my solicitor. So if you need any context in the industry, some people don't have a good financial planner. I'll give you my team that I use myself for my properties. They're all in Melbourne. They're very established companies. And if you want to source some projects, tell me what you need. I can put you on waiting list. And when I have those projects available, you'll be the first one to be notified. So I'll give you access to my personal network and create a bit of a strategy during the consultation. It's a step-by-step, basically, process. So for those who want to have the session, there's a couple of things you got to do. Obviously, the properties that I source, they start from 700,000. So if you're a single person, you need to be on about 95 grand per year. Like 80 is minimum, but 95 ideally, and about 112,000 in equity in your property or your parents' property or someone else's property. So you can actually borrow 700,000. I don't have anything under 700, very rarely. Like I've got these ones for 619. Like I said, if you're 80 grand a year, that's fine. But if you're on like 40 grand a year, 50, I can't help you. There's nothing that I can source that I can offer you. If you're a couple, it's about 80 and 60 grand per year as a couple working, then I can help you build wealth through property. If it's below that, I probably won't be able to help you. I don't do regional areas. I don't do house and land estates. I just do the top 50 suburbs in Melbourne, blue chip areas. So that's how you qualify for that. And yeah, just drop me an email, conrad@investorsprime.com, and just put complimentary 60-minute strategy session request and just your email address and your mobile number, and I'll contact you and make a time to catch up during the week on Zoom or on the mobile. So that's the no obligation, free 1-hour chat about properties and how you can build your wealth through property investing. I'm only offering these free sessions this year because next year I'm going to go back to full-time doing live events, and I've got I'll be hiring more people next year as well. So for those interested, just drop me an email. Also, as a special bonus for you guys, because you've been here for 2 hours with me, which is incredible, I'm going to give you a free home study access valued at $497, which you can access immediately. It's actually recorded 5 years ago, but look, 90% of it is the same, and it's really easy to follow. You just log in, you get a password, and you start watching videos. You download a PDF document, which is your manual, and it's absolutely free, no strings attached, nothing to buy. So you just go to that URL, realestateDVD.com/absolutely free access 2016. 10 hours of video, 265-page manual, and you can start educating yourself instantly after this webinar. Now, for those of you who want to get the latest one, I've actually recorded one in 2020. All you got to do is go into realestateMadeSimple.com.au, buy my book, and when you buy the book, either hard copy or soft copy, there's a page that pops up and says, did you want to upgrade to the home study? And it's $97, and you get the latest 2020 recording, which is actually 15 hours and about 400 pages of manual of education. It's $100, guys. And if you don't like it, if you think I've wasted your time, email me. I'll give you $100 back, and you can keep the home study, keep the book. Like it's if you don't need the information that I teach with Stephen McClatchy and Cameron Fisher is worth $100. And it's then definitely I'll give you a money back refund forever. There's no time frame on that. Anytime you're unhappy, just ring me up and I'll give you your money back or drop you an email. That's it, guys. Thank you very much. You've been an amazing audience. I really appreciate you guys sticking by for 2 hours. I went way over time. I hope you picked up a few tips, and I hope to meet you in person in the future at one of my live events or by having a consultation with me in the office. Have a great night, and thank you very much, guys. Any questions, just email me, and I'll answer them tomorrow and onwards. Thank you.